I ask you what were the defining macro events of the last decade, I dare say that many of them would have a half glass empty feel to them. The European debt crisis, Brexit, geopolitical events, trade wars, the pandemic. But what I'd really like to describe for you today and convince you today is actually the last decade has been a triumph of the optimists. And the next decade will likely, very likely, be a continuation of the same. So a decade ago, you had perfect foresight. You saw these political events occurring, these big macro events occurring, risks around financial stability, a global pandemic. What do you do with your clients' money? Well, there is an asset class that you can invest in so that you can reduce your volatility and sleep well at night and maybe get a little bit of capital gains along the way as well. And that asset class is, of course, fixed income. So what if you put your client's money, $10,000, in a global fixed income index in 2014 and redeemed that investment this year in 2024? Well, you've slept well at night. Unfortunately, today you've got nightmares because that $10,000 in nominal terms is now worth $10,133. Unfortunately, for Australian investors, inflation over this time period has been around about 25%. So you've gone backwards in real terms for fear of what those macro-driven geopolitical forces, what impact that could have on your investment portfolio. Now, what do you think I'm going to do next? You've all seen this chart. As a global equity investor, what if I said to myself, I'm willing to take a bit of volatility for the potential higher returns on offer, despite knowing in full well the world was going to experience a global pandemic? Well, this is what the MSCI World Total Return Index has generated over that time period, only the last decade. You've tripled your capital. Better than that. Now, of course, many geopolitical risk events have occurred. Negative macro, volatile events have occurred. But the equity market has charged on. The optimists have won. Positive, real returns. If you want to protect your portfolios against the eroding effects of inflation on your standard of living, equities is the place to do it. So the good news is, equities can make you rich. The bad news is, it takes time. So for the next 12 to 24 months, what do I want to see from a macro perspective to elongate the cycle that we've had in equities? Well, firstly, I would like to see inflation returning back to far more comfortable levels, closer to central bank targets. Now, many in this room would have studied economics at high school, and a famous quote, inflation is and always is a monetary phenomenon. And what I have here is US money supply growth on an 18-month lead versus inflation. The relationship is loose, but certainly the trend is your friend. And the US core PCE inflation, that pink bar there, or pink line, is actually returning far closer to the Fed's inflation target, to the extent that we're now seeing the market speculate on rate cuts as soon as September. So that's one tailwind for risk assets like equities. What's another tailwind that I'd like to see? Well, central banks have built up significant policy ammunition should it be required to support the real economy and that other half of their objectives, which is full employment. And central bankers like Jerome Powell are now saying that the good work done on inflation can allow them to focus on the employment the full labour part of their dual mandates. So we're already in a cutting cycle. EM central banks are well into their cutting cycles. DM central banks like the Swiss National Bank, the Bank of Canada, the European Central Bank, the Bank of England, the US Fed are likely to cut before the end of the year. So the good work on inflation has been done. It's returning back to more comfortable levels. As labour markets deteriorate and the growth outlook weakens to some extent, central banks have the ability to forcefully support the economic growth profile. And they have shown, with regards to financial stability concerns, that their policy toolkit has expanded rapidly. Think of SVB, think of Credit Suisse, as Chris mentioned. They have used their balance sheet to support the financial side of the economy, and they will use interest rates to manage inflation and labour markets. Now, as an equity investor, what we love to see is that pairwise correlations within the global equity market are low. At times of crisis, what you typically see is pairwise correlations within the global equity market spike. A tech firm is correlated with an industrial, is correlated with a financial. It's difficult for stock market or idiosyncratic fundamentals to really shine and for active investors to deliver alpha in those periods of market stress. But as we've seen risk appetite return over the last 24 months, what we are seeing is the market is being discerning around the winners and losers within the equity market, and that is a ripe opportunity for high conviction, concentrated investors that do fundamental analysis to deliver alpha over the medium term. Importantly, as we start to see rate cuts come through, the earnings cycle can re-accelerate, particularly for those stocks outside of the mega cap type names that have driven the market over the last 18 months. That earnings recovery is anticipated to be well underway this time next year. So to conclude, as we've evolved from the plains of the bush in Africa, etc., it paid handsomely to beware of bad news. It was very important to understand what that noise in the bush was. Was it a stick? Was it a snake? If you're more conservative, you survived. Unfortunately, investments works the other way around. Beware of bad news. Beware of geopolitical and risk events shaking you out of your long-term investment time horizon and shaking you out of your risk positions. There are significant tailwinds for risk assets at this point in the cycle, so we're bullish both in the short term and of course the long term. I've shown you 10 years of equity returns. It can go back 120 years. It can go back before world wars. It can go back before pandemics. And you'll see that equities are really the place to generate wealth over the long run. And finally, it is a ripe stock picking opportunity or market at the moment. It is really an opportunity that active global equity investors and Aussie domestic investors can really shine through. So stock markets, volatility is the price you pay, but they are the great wealth generating machine. Thank you.